Okay, let's talk about the analysis of financial statements. Clearly not one of the most 10 interesting topics in finance, but we have to do it. Companies will look at their own financials to look for disturbing trends. Do they have days sales outstanding that's too high? Are customers taking too long to pay us? Lenders will take a look at our financials to try to figure out if they should lend us some more money. Do we already have too much debt? So they'll look at times interest earned. And shareholders are going to look at the trends in our net income and in our free cash flow. Should they sell the stock or should they buy more? So let's talk about the analysis of financial statements. A good place to start might be looking at free cash flow. How much cash is left over after they pay their operating expenses, after they pay their taxes, after they maintain their current and their long-term assets. And with any of these numbers, a single number isn't very meaningful. We'll have to compare it to the company's history and compare it to the industry to determine whether it's a good number or a bad number. Next, we might look at ratio analysis. We've got to compare companies of disparate sizes. And one way to do that is to look at ratios. And we might break them down as profitability ratios, asset management ratios, debt management ratios, and market value ratios. Three other tools might be trend analysis, common size analysis, and percentage change analysis. That trend analysis is a little misleading because we're always going to be comparing this year's numbers to last year's numbers to the numbers before. So we're always looking for trends. We might also use the DuPont equation. Back in 1912, a fellow named Donaldson Brown, working for the DuPont company, came up with this different way of looking at return on equity that's supposed to help us see a little bit better what's going on with our company. All right, free cash flow is not defined by generally accepted accounting principles. So every financial analyst may have their own way of calculating free cash flow. The simplest way is to start on the statement of cash flows with the net cash provided by operating activities. For this company, it would be 163. Then subtract the money they have to spend on their fixed assets, 420, to give us negative free cash flow of 257. A more sophisticated way to calculate free cash flow would be to start with EBIT, earnings before we subtract interest and taxes. For this company, that would be 400. Then multiply that number times 1 minus our tax rate. If this company is in a 25% tax bracket, that would be 400 times 1 minus 0.25 or 300. And you can think about that as our cash in. Now we have to figure out what cash we had to put out to maintain our operating assets. Remember from accounting class that net working capital is current assets minus current liabilities. Let's assume that the short-term investments for this company are not part of operations and that the notes payable are not part of operations. So we'll subtract 600 from 1,600 and that'll give us $1,000 of net operating working capital. At the end of 2019, we have $1,000 invested in net operating working capital. Add to that our $2,000 investment in net property, plant, and equipment, and that gives us $3,000 invested in total net operating capital at the end of 2019. We run those same numbers for 2018, and we discover that at the end of 2018, we had $2,490 invested in total net operating capital. So that means our money out to maintain our operating assets was $510 during 2019. Take our cash in of $300 minus our $510 out to maintain our assets, and this company has a negative $210 in free cash flow during 2019. Probably not a good thing. Negative cash flow is fine for a growing company in its early stages, but generally you'd like to see some positive free cash flow from a mature company. Okay, let's start looking at the ratios, and you can break them down any way you like, but let's break them down as profitability ratios. Are we making money? Asset management ratios. How are we using our assets to generate sales and profits? Debt management ratios. Do we have too much debt or too little debt? And market value ratios. What does the market think of the job that we're doing? Let's start with net profit margin. Let's take our net income available to common shareholders of $248 and put it over our sales of $5,000. and that'll give us 4.96%, which rounds up to 5%. Is that a good number? Is that a bad number? We'll have to look at the trend within our company. We'll have to compare ourselves to the industry to see if that's a good number or a bad number. Next, we'll look at operating profit margin. We'll take EBIT and put that over our sales. Net income is a great number, but that subtracts interest and taxes and other items like the sale of surplus property. We want to focus on their operations in this ratio, so we'll take earnings before interest and taxes, EBIT, of 400 and put that over our sales of 5,000 for an operating profit margin of 8%. Next, we might look at the basic earnings power ratio. We'll take our EBIT and put it over total assets. In this case, that would be 400 over 3610. And this is probably a great time to mention that every textbook is going to have slightly different versions of these ratios. Doesn't mean some are right or some are wrong. For example, somebody might take the average assets in the denominator of this ratio. But for now, let's just make things easy on ourselves and put in the ending total assets. Next, we might take a look at the return on total assets. We'll take our net income available to common stockholders, put that in the numerator, and in the denominator we'll put our total assets. The reason we don't put in the total income of 255 is that the preferred shareholders get their return in the form of the preferred dividends. We're more interested in what the common shareholders get, which is the net income available to them over the total assets. And our final profitability ratio is the return on common equity, net income available to common shareholders over common equity, in this case 248 over 2240. Please don't forget that retained earnings is part of common equity. And please remember that at the end we're going to talk about the DuPont equation, which is going to take this return on equity and break it down to make certain trends and certain policies more visible. Let's look at a few asset management ratios to see how we're using our assets. Are we using them effectively? The first one would be the total assets turnover ratio, sales over total assets. How are we using our assets to generate sales? In this case, that would be the 5,000 over the 3610, which is about 1.39, which rounds up to 1.4. Next, same idea, but let's take our sales over our net fixed assets. We'll call this the fixed assets turnover ratio. How are our fixed assets, our factories, our distribution centers, our stores, generating sales? We're looking at asset management ratios. Let's look at how we're managing our accounts receivable. That's an asset. We'll look at days sales outstanding. We'll put our receivables in the numerator, and again, some textbooks will use average receivables, and put that over average sales per day. Well, how do we find the average sales per day? We divide the total sales by 365. In this case, we'd end up with days sales outstanding of 500 divided by 13.7, which equals 36.5 days or 37 days. So if we're asking our customers to pay us in 30 and they're paying us in 37, that might be something we want to look at. Should we put somebody in charge of accounts receivable? Should we offer better terms? How can we get our customers to pay us faster? Another asset for us to manage is our inventory. Are we effectively turning it? The faster we turn our inventory, the better. And so we might calculate our inventory turnover ratio as cost of goods sold over inventory. And in this income statement, they have broken out the depreciation and amortization from the other cost of goods sold. So our total cost of goods sold is 4,100 over our ending inventory of 1,000. Again, other textbooks might take an average inventory, but today we're just going to take our 4,100 over 1,000 for a 4.1. Is that good or is that bad? We'll look at last year's, we'll look at the year before, we'll look at the industry average to try to determine if we're filling up our warehouses and emptying them out fast enough. Let's look at a couple liquidity ratios. A company needs to have cash and current assets to run their daily business, but we don't want too much tied up in current assets. Too much cash and then not getting a good return on it. Too much inventory and they're paying too much in financing to support that inventory. So the first thing we might do is check the current ratio. Current assets over current liabilities. This is the same ratio you had in accounting class. 1610 divided by 750 is 2.147, or about 2.1. But one of the shortcomings of the current ratio is it includes inventory. Inventory takes a long time to sell and then collect on. So let's take a look at the quick ratio. Take your total current assets minus your inventory divided by your current liabilities. In this case, we'd end up with 0.81, or about 0.8. All right, let's look at some debt management ratios. How much debt should a company have? Just enough. Too much and they won't be able to handle the interest expense. Too little and they're not leveraging themselves to expand as quickly as they should. So in this context, leverage means debt. So the first ratio we might look at is debt to assets ratio. Total debt over total assets. In this case, that would be 670 over 3610 for a debt to assets ratio of 18.6%. A different ratio to come at the same notion of how much of our firm is financed with debt would be the debt to equity ratio. We'll take total debt over total common equity. So in this instance, that would be the 670 over 2240 for a 0.3 debt to equity ratio. Another measure might be market debt ratio. Let's assume that this company has 60 million shares outstanding, trading at $31 a share. Let's take total debt over total debt plus market value of equity. In this case, we'd end up with the 150 plus the 520 over the 150 plus the 520 plus the $31 per share times 60 million shares. So we end up with 26.5%. Another debt management ratio might be the liabilities to assets ratio. Take total liabilities over total assets. In this case, that would be 1270 over 3610 to give us 35.2. A measure to see if a company already has too much debt might be their times interest earned ratio. Let's take EBIT, earnings before interest and taxes, and put that over interest expense. For this company, that would be 400 over 60. So on an annual basis, they have operating income that is 6.7 times their interest expense. Some companies don't own their long-term assets and borrow to buy them. Some companies rent their assets and make lease payments instead of interest payments. So a measure of their EBITDA coverage ratio might be a good idea. We'll take EBITDA, earnings before interest, taxes, depreciation, and amortization, plus the lease payments over interest, plus principal payments, plus lease payments. And let's assume that this company has principal payments of 20 million and lease payments of 28. So we end up with 628 over 108, or 5.8 times. Let's look at some market value ratios. The first one's really important, the PE ratio, the price per share over the earnings per share. Let's assume that this company has 60 million shares out there trading for $31 a share. So their price per share is 31. Their earnings per share is that 248 divided by 60 million, or 413, for a PE ratio or price earnings ratio of 7.5 to 1. Or we might look at the price per share over the free cash flow per share. If the price per share is 31, and remember we calculated the free cash flow, the extra cash after the company pays their operating bills, pays their taxes, and maintains their assets, of negative 210. Divide that by the 60 million shares that are outstanding, and you end up with an unpleasant minus 8.9. That's the price per share over the free cash flow per share. Or we might look at the market value per share to book value per share. Well, the book value per share for this company is 2240 divided by 60 million, or $37.33 per share. So if you think about it, if the assets are on the books for what they're worth, which is not exactly true, if we sold all our assets and paid off all our bills, we'd be left with $37.33 per share, yet the stock is only trading for $31. So our market to book ratio is $31 over 37.33 or 0.8, which is probably not very good. But again, we'll have to look at the industry average, we'll have to look at the history of our company to confirm that that's not a very good. And we can get the same answer instead of looking at it at a per share basis, but looking at it at a company-wide basis. We'll take the market cap, which is an important number. The market capitalization is the price per share, in this case $31, times the number of shares outstanding, which is 60 million. So the market capitalization is 1860 over the book value of the equity, which is 2240, which gives us that same 0.8, which is still an unpleasantly low number. As we say, one number really doesn't tell us much. We're going to have to look at the trend. What has the company been doing? What has the industry been doing over the last 5 to 10 years? So we might do some trend analysis on these individual ratios to get a feel for which direction the company is going, especially compared to the rest of the industry. Or we might create common-sized income statements and common-sized balance sheets. So instead of dollars, everything on the income statement is stated as a percentage of sales. On the balance sheet, everything is stated as a percentage of assets. And that might make it easier to see trends, see good things, and see bad things. Or we might pull everything together from our ratio analysis and use the DuPont equation, which comes from Donaldson Brown back in 1912 when he was working for the DuPont company. He took return on equity and broke it down into 3 components. And if you look at this, the sales in the numerator and the denominator cancel each other out. Total assets in the numerator and the denominator cancel each other out. So we're left with net income over common equity, which is our return on equity. What this formula is supposed to do is to help us see why is our return on equity higher or lower by looking at the profit margin, the total assets turnover, and what we call the equity multiplier. All right, I hope that helps you get through your chapter on ratio analysis.